Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer and today we are going to be analyzing Cisco Systems stock. This one came in by request down in the comments section of one of my other videos. If you have a request, just drop it down in the comments. I will get it on the list on the whiteboard behind me, and eventually I will make a video. If the stock is in the S&P 500, I post those here on YouTube for free, and if it's not, I post those on Patreon, which is $5 a month, and also in the full Cyclical Investors Club service over on Seeking Alpha. If you join Patreon, you can get a big discount to the full service, where I have spreadsheets, chat rooms, all kinds of stuff, lots of articles that aren't available to the public. And those links will be down in the description. As always, this is not individual investing advice. This is just how I analyze stocks. So I'm going to share with everybody what I think about when I look at a stock and the metrics and everything that I'm using to determine whether I want to buy or sell or avoid or whatever. So I had a request for Cisco. This is a pretty interesting one. Most stocks right now aren't super interesting to me because the market's pretty expensive for most things at the time. But Cisco is, and I'll tell everybody why. Well, let's just go through the process first here. If we look at their earnings pattern over time, it's not very cyclical. So it basically goes up and to the right since 2004. Not a whole lot of, it fell 6% during the Great Recession, which is understandable. I'm not sure they've had any other down years. This year is expected to be slow. Let's take a look. This year is expected to be flat. So inflation adjusted, that isn't great. So we have kind of slow, let's see the fast graphs growth rate, 6%. I'll show the adjustments that I make to that in a moment. So 6% over this time period is, I think I actually go back to 2015 on my, is not great, but it's not bad. It's like kind of, a stalwart type of growth rate, which is what Cisco really is. So the question really is, so it has adequate growth. One thing I will note is they have bought back about 20% of the company's shares over the past 10 years or so. And when I control for that, I get, let's see, a 4.45% growth rate. So that's just over my minimum 4% that I require really for me to buy a stock nowadays for a less cyclical stock. But because Cisco's earnings have been so steady and reliable, it would be okay to come and buy it as long as the price was right. Because there's not a lot of risk really. It's just the real risk is are they ever going to grow more? And what price you want to pay for it. So right now it's trading about a 13 PE. Just off the top of my head, that seems about right for 4 or 5% growth or whatever. But we'll crunch the numbers here in a minute. So maybe actually let's do the numbers first, and then I'll talk a little bit. I'll come back to another topic. So we have the 4%, 4.45% earnings growth. This is adjusted for the shares that they bought back. So this is what earnings growth would have been if they didn't buy back those shares. Because if you look at earnings per share, if you lower the number of shares, that inflates the earnings per share growth. Also, probably they got some help these years from tax cuts. So, yeah, I think I'm being pretty fair if you think of this as buying the business and you're the owner of the business, and the earnings that they make, you're going to just keep for yourself and spend. That's how I like to think about it. So when I make those adjustments, that's more of like a 4.45% growth rate. So then you have to say, well, what are you paying for the current earnings? And that's where the PE ratio and the earnings yield come in. They don't really have much debt, so I don't make much of an adjustment there. And so the earnings yield, which is what's here, that's the inverse of the PE ratio. So the PE ratio is price over earnings. The earnings yield is earnings over price. And that's going to be 7.5%. So the relevance of that is I want to know how much in earnings I would collect as an owner of this business if I paid $100 for it. So if I paid $100, the business would earn $7.50 the first year, and then I would collect that $7.50 each year as long as if earnings stayed the same. But we do expect earnings to grow 4.5%. So what this does is it shows how much you would collect over time with your $7.50 growing at 4.5% on your $100. And I want to know how much I would collect after 10 years, which is about $96 on my 100. So if you do a CAGR calculation of that over 10 years, you get about a 7% CAGR. Just in terms of absolute numbers, like 6.5% is what I consider about fair value. So this is a little cheaper than fair value. However, and then about above 8% is kind of my buy threshold. That usually means you're getting a good price, and there's also a margin of safety there too. So right now we're a little undervalued, just to the 6.5% standard, but we don't really have a margin of safety. That's how I would describe it right now. That's if history just keeps going on as it has the past 8 or 9 years. So the question here is, but one important thing I want to point out is the rest of the S&P 500 is actually more like 5.5% CAGR on a 10-year basis on the ones that I track that are steady earners, which is like half the index. So this is actually a pretty good value relative to the rest of the market. Actually, of all the almost 600 stocks that I actively track, this one is in the top 30 of value right now. So it's pretty good relative value. I have not bought it yet, but I'm watching it closely. So at the point at which it would flip over to 8%, assuming earnings expectations are roughly the same, is about $41. So that's where I would probably be buying. I'm kind of hoping that they have a bad earnings report or guidance or something like that, and then the market kind of sells it off, and hopefully, which is what happened during the last quarter. And so I'm hoping that happens again so I can buy it, because I think there is potential for growth in the future. And one of the reasons, maybe better growth than this, but one of the reasons I think that is their recent announcement that they're purchasing Splunk. I believe it was Splunk. So usually I don't like it when companies are making acquisitions, but in this case I actually track Splunk, and it was almost a buy for my fast growth strategy. And Cisco came in right at that level and decided to buy it. And so I think it's going to work out pretty well for Cisco. I think it's going to be, which I don't usually say, but since I had already done the valuation on Splunk and I had almost bought it myself, I think they probably are going to get a good deal. But the thing is, I would say it's going to take 3 years probably before we see any of that really work itself into Cisco's earnings growth. So my hope is the stock sells off in the next year, I can buy it, and then later on maybe that 4.5% growth gets up to 7, and now you got a value on your hands. Now you got the stock price will give you a good initial bump, and then hopefully they can maintain that for several years, and you're going to have a very good, very safe purchase, and you can kind of buy it and forget about it for quite a while, but you just have to be able to get it at a good price. So under $42 is kind of where I'm looking at over this next year, basically. And I probably will use that even if bad news comes out, and step in and buy it if I can get it that cheap. It doesn't really fluctuate too much. Did we get down there here? Yeah, we did. So we just last fall, we did get down to those levels. And I think if we got down there again, maybe if we got lucky, you could buy it and then the stock makes a double bottom and then earnings growth picks up. And that's the bull case. A person could buy right now and they would probably be just fine using the same idea, the same thesis. But that in getting it cheap is important because these guys probably aren't going to take off on some massive, huge growth run. So you want to make sure you buy it cheap. So let's just look. I'll give you an example. I won't even go back that far. Let's go back to here. So let's say you bought it at 10 PE, which is probably pretty similar to what it would be if the stock price fell another 17%. And you bought on this dip. So Cisco hasn't really done a whole lot compared to, well, let's first compare it to here, right? To a 17. But they knew these earnings bumps were coming probably. So in that case, you get pretty similar to what Cisco's earnings growth has been, 5.5%. But if you were able to buy during the dip, the difference is 13% CAGR. So that's pretty good for a pretty low risk, right? So that's really what we want to see. And it's kind of the same as if you bought let's say not buying up here, but let's say you bought pre-COVID. You're looking at, again, right, similar to that growth rate that we saw earlier. But if you bought during one of the dips, maybe not even the COVID dip, but during this later dip, now you're looking at that 13, 14. So I want that 13, I want it that easy 13, 14 for 10 years or something rather than the 5% for 10 years. So that's the difference between, and then also you just get a margin of safety. Maybe something else comes out. Maybe their business slows down more than we expect and tech changes and so forth and so on. So all that stuff can happen too. So you get that benefit of having the margin of safety too. So this is definitely one to watch. I probably wouldn't have voluntarily even shared this since I haven't bought it yet, but since somebody asked me about it, here you go. If you have a request, put it down in the comment section. If you found this useful, like it, like the video, subscribe. We're growing really fast since I relaunched the YouTube channel in October, and we can always use more folks. So I'll see everybody later. Bye.